Tell me a little bit before I start asking you all sorts of questions about the investment environment. How has this all been for you?
Well, this has been a pretty remarkable uh, uh, environment. Imagine, sort of around last year end, if somebody told you that we were going to have the voluntary closing of the world's economy, with certain exceptions to just keep food moving and other things, you would say something like that couldn't happen. And if it did, it would result in a global depression. Uh, and it just like wasn't on the page. And in effect, uh, those directions to almost every country to stop your economy did occur, and unemployment has gone up massively. But we haven't had a depression, and the reason for that is that we've learned from the past, and you've had massive government intervention, massive transfers of trillions of dollars of monies to people who need it to, in effect, replace the lost revenue from shutting our economies. And that first big stimulus bill in the United States, followed by uh, really very, very large follow-on by the central bank in the United States, the Fed, is pumping unprecedented peacetime monies into economies. And in fact, the amount of deposits in banks because money was transferred to people has exploded. And so we are awash with liquidity that was necessary. To give you some idea, U.S. GDP is around $21 billion, trillion dollars a year, and
Right.
say we miss a quarter or more. So we're sort of missing 6 trillion coming in, and somebody's got to fill that hole. And that's what all these stimulus bills and the Fed, in effect, are doing in a very simple way. And so we've had this dramatic collapse. Stock market's down 34, and now it's bounced up as if nothing had occurred because of the liquidity and support from the Fed, and also the
So
sense
let
that,
me ask you about that.
yeah,
So Steve, if I may, that specific point is one that I really feel like I want to understand from your perspective, which is this apparent disconnect with every headline that we're reading every day related to virus cases going up, this medical crisis, this health crisis that we're going through, and a stock market, if I even just look at my own 401k, that has rebounded. Is it just basically the liquidity that's been pumped into the system? Help me understand this gap.
yeah, I think it's mostly the liquidity that's in the system, and also some uh, elements of confidence. In other words, you have 130 uh, vaccines that are in the process of development. The fact that we'll go 0 for 130 uh, really seems remote. There are three different types of vaccines, and so I think people are much more optimistic that's going to occur on a time frame that's way different than the development of vaccines was in the past, where the fastest one was like 4.5 years, and people have optimism that within the next 9 months we'll have enough positive, could be a year, outcomes from trials that you'll get there within a year to start really producing large scale vaccine. And there's other therapeutic breakthroughs that are occurring if you get the virus. The second thing I'd say about these cases going up, how could one believe they wouldn't? Um, I don't find that surprising. People have been locked up in their homes for 2 to 3 months. And when you let them out, there'll be more socialization. Uh, and people won't understand truly that this can get them sick. And once they see that, and the appropriate government response will be to first really warn people. In democracies, apparently, they like to see bad things happen before people in democracies actually respond. So I completely expected this to happen. I think the markets did as well, and that will be put under better control because there's no option. Nobody really wants to get sick, and so you'll have change in behavior as the number of cases goes up, and eventually that'll be beaten down. But I think it's you'll also see a big V in terms of the economy going up for the next few months because it's been closed. And as people are allowed to go back, the economy will really respond a lot. But there's only so much the economy that's highly complex can respond, uh, just because not all things go up equally, and it will take quite a while before we sync up and get back to 2019 levels.
So, Steve, when I think about your experience, I know that Blackstone is a place where you're always looking at opportunities and new opportunities in many ways. I think back to the turn of this century and the big bet and a lot of investment you made in real estate. I think about the last financial crisis and how heavily you invested into credit and distress through GSO and other means. What's something that you're doing now? Take us inside Blackstone that might help us understand the opportunities that exist in this latest crisis.
Yeah, well, this one's different. They're always different. And the easy things to have been doing was when you hit that bottom, even if you didn't know it was the bottom, to be making significant investments. We reported just at the end of the first quarter that we'd invested $11 billion in effect liquid securities, and that's of course had a very happy outcome. And we did more in addition to that, and that's sort of a first stage. Uh, I think each of our businesses are now seeing interesting opportunities. Um, and as technology is changing things and people are staying home more, um, the areas where you'd want to invest, whether it's technology or healthcare, uh, are being modified. Certain older economies that are bound to be disrupted, those types of companies are places where, um, unless you have a really remarkable management, you'd be wanting to stay away from. We can see different parts of the economy opening faster. Um, some things were closed completely. Interestingly, in the hotel business, we owned one hotel uh, in Las Vegas, completely closed the first weekend it opened. It was 45% filled. That's an astonishing thing because Las Vegas was barely open. So there will be some surprises, not all hotels, but as you look at the gradation, places where you can drive will recover much faster. Places where you have to fly will recover much slower. And if you have to fly over oceans, those will be the slowest recovering types of investments. So each of our businesses is starting to really put out money, our business lines, and there's a much better tone. To do a lot of private investing, there has to be some confidence on both sides. Sellers have to believe they're getting fair value, and the people who are buying think they're getting fair value. So there's an overlap. Typically, what happens, as you know, Jason, if you're doing private investing, that sellers don't like to sell at bottoms. Um, you can buy liquid securities, you can buy debt securities of uh, CMBS and other things that are stacks where you can, find the security where you think it has the most upside, even if it's gone up halfway from where it started, some of these will continue to go up, and others have already returned to par. So it's an issue of figuring out which of the underlying businesses are going to return to health. We're taking a basic view that it's not particularly interesting to buy securities in what are really challenged businesses, challenged business models. And those things trade at very deep discounts. And if those companies make it, that's a good thing. But the chance that some of these will recover as nicely as you want uh, is perhaps compromised in this cycle because of the impact of technology and change behavior uh, of, of people. We've made a huge amount of money continuing to build our warehouse platform. We're either the largest in the world or the second. We bought about 1 billion square feet of warehouses. Why did we do that over the last 10 years? Because we saw the online business exploding, and we saw concomitantly that regular retail was going to get really hurt as consumer changed. The pandemic has accelerated trends that might have taken 5 years and made it happen in 3 months. And so we're very mindful of these types of changes and are investing around those type of those changes.
So, Steve, when you think about how Wall Street may change out of this, it clearly changed after the financial crisis. And candidly, Blackstone was a big beneficiary of that. Your business grew at an enormous rate. How does the investing world, how does Wall Street change on the back of this particular crisis, in your estimation?
Well, it's interesting. I mean, if you take the different parts of Wall Street, take the banking community. I think the banking community went into this crisis very strong, and they're going to come out strong. And so that's a big change from the last financial crisis. In the money management area, I think that the index fund business will continue to gain share because it's not been bad at all to be long equities. And by the same token, um, the alternative class will also to continue to attract a lot of money. The long only managers in the middle were sort of disadvantaged. I think their performance will end up being better than people thought. So there'll be a little more stability, but the basic trends of index funds and alternatives will continue. I don't think you'll see that many mergers in the money management area, and the brokerage area has pretty well been consolidated. So I don't think there are going to be enormous changes coming out of that. You'll continue to see more and more money being managed using quantitative uh, uh, techniques. It's already up to around a third. It could go a little higher.
So, what do you do? And do you expand? I mean, you've expanded in every downturn pretty meaningfully. Are you looking for things to buy at this point? Are you looking for other businesses to expand into at Blackstone?
Well, we've set some seeds for expansion um, before we went into this because we thought we knew where the world would present opportunity, and one of those areas is in life sciences. And we just finished raising, or about to finish, a life science fund, and that kind of focus of the world with all the vaccine, and everyone's now an amateur expert in sort of COVID and what we have to do for the future. So that whole healthcare business is going to really grow, and growth equities, the use of technology and rapidly growing companies is going to do very well. We believe, and we're raising a pool for that. And we'll see what comes out of this crisis. One of the things about starting new business, which I guess we've done in the financial area about as much as anybody, is you have to see what starts occurring. Some of these trends you just can't miss, and how you play them is what's to be determined. At the moment, we're quite well placed, but it's almost like you can't find enough of disruptor types of technologies and applications of those for people and fintech and a variety of things that take advantage of this kind of change world is where one has to move. I'll tell you one other thing that we've learned, which is that the quality of management at a time of disruption is more key than it ever was. If you have relatively stable positions in markets and products, your management could be good, not great, and life will go on because you're either patent protected or process protected. But in a world where everything appears to be challenged, whether you're the disruptor or the disrupted, the quality of the people managing that change, reacting to that change, takes a completely different amount of importance. And you know, we're going to pay even more attention because great managers can create great results, and okay managers, which used to be okay, uh, will not have okay results.
I read in a book that came out last year that you only hire A players, right? Didn't I read that somewhere? Some book that I read?
Yeah, I read that book too. The difference is I read about 30 drafts of it, as opposed to you just having the good luck of reading one draft. And
Exactly, exactly.
you know, that turned out to be a bestseller. It's called What It Takes, and you know, I wrote it, and you know, it was the #1 book in China as well. So and you know, I just got contacted by the Mongolia market, you know, and all over the world. So it's been a very interesting adventure for me.
I always said you were going to be huge in Mongolia, Steve. It was a very good book, and I'm glad you got to plug it here. I'm sure the paperback is coming out soon. Well, you talked about China, so you gave me an opening. You demonstrated in that book that you know as much about China as any modern businessman. I'll say that so you don't have to, as a philanthropist, as someone who has intimate knowledge of the market and the key players. Given everything that's going on in the world right now, not just virus related, geopolitical, geoeconomic, how much should we be worried about a decoupling with China?
Well, I think this decoupling that is going on is uh, uh, a very unique situation. I mean, the U.S. and China together, depending upon who's doing which measurement, are about 40% of the global economy. Now, imagine that. There are over 200 countries, and two of them are close to 40%. This is stunning. And there will be changes, some of which, you know, would be expected when you have some element of geopolitical rivalry. And now with COVID, which is the first time that borders have really been closed around the world, businesses and to some degree governments are concerned about supply chains because there's been a huge concentration of supply chains in China because they're so good at manufacturing and so quick in terms of the ability to establish those effective supply lines that a number of companies, when they couldn't get supply, just simply by the nature of China being closed, and then subsequently every other uh, country in the world closing its borders, that this is a scary type of prospect for business people. And I think they'll respond to some degree uh, to diversify supply chains, and that will be normal. Some verticals, some areas, whether it's pharma or whatever, healthcare will have more focus on those types of changes. But meanwhile, I think what will happen is China will, with its 1.4 billion people, will continue to grow because they will internalize their markets, and you can do that at that scale and depend less on exports. And I think China will continue to grow at double or triple the rate of the developed Western countries, but the mix will be different.
Does that worry you about growth in the United States then, just taking it as a whole?
Well, I think for the U.S. We have a lot of advantages um, on our own. We'll get some more internalization. We'll lose some exports through that process. We have super low interest rates. We're running massive deficits. We're doing everything we can uh, to promote growth. So I'm not worried about U.S. growth in particular on a longer term basis. One of the most important things that people don't think about so much is the quality of our education. And we have great universities, but as a country, for the last several decades, we've underperformed in the primary and secondary area of schooling. And I think we need to have a refocus because this is what provides the underpinning in the post-industrial age for vibrant economies.
So, Steve, I do want to talk briefly about sort of the other crisis that we're facing, which is one of racial injustice and a lot of the social unrest that came in the wake of the killing of George Floyd and the aftermath of that and all the discussions that we're having about what we do next. One of the interesting theories that I've heard from a number of big investors is that private equity has the ability, given its vast influence over big chunks of the economy, and you and I have talked a lot about this before, the knowledge that you have, the relationships with CEOs and the control or the influence over a lot of companies. What's private equity's general and broad role in maybe trying to fix some of the ills that have been so clearly laid bare in the last month or so?
Now, I think this is a broader societal issue than private equity, of course, and the sort of killing of uh, uh, on television uh, was so upsetting to so many people that it's triggered this relooking at equity in a variety of areas. And I think everyone wants to do something to rebalance the society and the opportunities. And in our firm, for example, we've already had what we call affinity groups for women, for veterans, for LGBT people, for our Black employees. Each one's a separate group, but anybody at the firm can join any group they want, regardless of whether they have the exact qualifications for that group. And as we look at things, we turn to our groups and say, what can we do better? How can we help this situation to rebalance? Uh, and I think that we're also looking at our portfolio companies and seeing what we can do. And I think, as you mentioned, Jason, this is a good area, and so this whole moment in time is sort of creating a productive reevaluation of things. And I think everyone in society would like to make sure that the promise uh, of equality of opportunity and should be equality of preparation occurs.
So, Steve, as you think about, with all the conversations that you have with your peers, portfolio companies, heads of state, I do wonder what sticks on the other side of this, of these dual crises that we continue to live through in terms of the way companies operate, the way decisions get made. You mentioned earlier in the conversation that this is a real test for managers to sort of weed out who's really good at this. I do wonder, and maybe this is even for yourself, what's different on the other side when we get to the next normal, as it were?
Well, we've certainly been through a test. It's a test for society. Uh, you know, I still find it astonishing that you managed to have the vast majority of people around the world sort of go into suspension for 2 to 3 months. And so there's going to be all kinds of changes that come out of that, and changes in some values, changes in how work is done, um, how people relate to each other, uh, that the way they choose to have quality time, uh, and even just sort of being in shape. Some people like myself, you have more time. I spend more time in the gym and changed what I'm eating. I've given up profiteroles and all kinds of wonderful things, and now I'm in much better shape. Some people, went the other way and bulked up. For example, it's hard to imagine, but I was watching a TV show at night, and the journalist reported that purchases of alcohol in the United States went up 455% in 1 month. So we're going to have a lot of things to undo. We're going to work to find a new normal. And for people, we just had a graduation of this program I have in China called the Schwarzman Scholars, and we told the students that they're going through an unprecedented time uh, of high unemployment and uh, this impact of COVID. And in a way, and I said this to our people who were younger at the firm, that they're going to be lucky. And the reason they're going to be lucky is their world at the start isn't going to be so good. And they're going to
Mm.
find a way to make it work, because there's always a way to make it work. And for their lives, they'll always be more wary and more clever than the people who started at a time where everything went well. And so our job is to help each cohort, if you will, of society adjust to this. And adjustments there will be. And we're not into a regular way world now. And when we come out of this, 2 years, 3 years, everyone will be affected. And they'll
Yeah.
carry those lessons learned into the future.